Good evening, everyone. Welcome to our Long Beach Homebuyer Workshop. My name is Jason Maida. It's great to be with you this evening. Thanks for taking time out of your busy day to join us for our homebuyer class. So we get a chance to teach these really kind of once a quarter to our Long Beach alumni, and you can see us at mortgageeducate.com to kind of get a sense of like all of our different classes that are upcoming. So we generally do these at least once, maybe every other week. So again, thanks again for joining us this evening. Tonight, just go over some kind of housekeeping with you. So we try to make these very interactive sessions for you. So as you saw in the chat box, Ken Fleck's going to be handling some of our questions that come in through the evening. And then what we'll do is we'll bring some of those questions back to the larger audience and answer those while we're going through tonight's class. So we really want to try to make it as interactive as possible for you as we roll through tonight's slides. Now, our discussion tonight should last just about an hour, and we'll kind of weave in those questions as we go through tonight's content. We'll wrap up tonight also with a Q&A session. So if you have some questions, you can certainly ask those during the presentation, or we can save those to the very end, okay? So thanks again for connecting with us. And just really quickly about me. So I'm the branch manager here for American Pacific Mortgage, and we service 3 states from our office, primarily focusing our attention in the California markets. So Northern California, Central Valley, and of course in Southern California. So many of you may be joining us from Southern California, but we also, we may have some of you connecting with us from the Bay Area or maybe even the Sacramento markets. So our specialty is more around first-time home buyers. So for those of you that are first-time home buyers, that's probably why you're taking our class this evening. We are going to spend some time talking a little bit about the first-time home buyer assistance. So we partner with CalHFA, which is the California Housing Finance Agency, and it's designed to help low to moderate income households achieve homeownership. So you're going to learn a little bit about that this evening. We'll also talk about some of the core products that are available to you as first-time buyers, conventional loans, FHA, VA, USDA, and like I just mentioned, the CalHFA loan. So we'll spend some time diving into that this evening. Let's look at our talking points for tonight. So we're going to look at the housing market. Lots going on there. In fact, I was just talking to a client here a few minutes ago about kind of what's going on in the San Diego market with regards to some of the inventory levels, which is not any different than what we're seeing across other markets in California. So we'll look at the housing market. We're also going to spend some time looking at does buying make sense. This is probably going to be one of the largest investments you make in your lifetime. So, the fact that everybody's taking time out this evening to join us for the next hour to learn about homeownership tells us, how much that, you want to invest the time and energy to discovering the right options for you as you go on this path towards homeownership. So we'll kind of take a look at does buying make sense. We'll also look at credit and how credit influences our buying decisions as well as our cost of financing. We're going to spend some time looking at student loans just briefly around the obligation and how that gets factored into your home buying qualification. We'll look at loan programs, some of the documentation you need for home buying. Like I mentioned, we'll talk about some down payment assistance programs through CalHFA. And then we'll wrap up tonight's discussion looking at the overall process of buying a house. We call that our 6 steps of home buying. And then I'll take you through kind of what the framework looks like for a personal consultation for home buying. Okay, so lots of great stuff that we're going to share with you this evening. Really excited to bring it to you. And again, thanks for joining us for tonight's discussion. So when we think about buying, it's probably going to be one of the largest investments we make in our lifetime, right? So many of you that are joining tonight is because you really want to figure out, what it could look like to be a homeowner. Many of you are paying rent today and probably seeing your rents climb throughout the year. And so when you're looking at homeownership, while it's a very competitive market, still presents a huge opportunity for us. Benefits also come with buying a house, the ability to create more stability in your housing payments. So you're not worried about your lease going up every year when you renew. It's an asset, so you have the ability to be able to pass along the asset to the heirs of your estate. And there's equity that gets accumulated through the growth of your home or the appreciation of your home. Equity is created in the difference of what you owe on a house versus what the market value is. And then, of course, there still is tax benefits with owning a home. So the potential deductibility of interest on a mortgage. So a lot of great things that come with home buying. Now, as we're planning for our home purchase, we want to look at our budgeting. And we really actually want to look at, what does it look like today for my current housing situation versus what could it look like as a home buyer? So one of the places we like to start off as we get going in our presentations is to take a look at the Freddie Mac rent versus buy calculator. And we're going to drop into this calculator and just kind of build a what if scenario for you as we're starting off tonight's discussion. By the way, all the material that we share with you this evening, we're going to send out to you tomorrow morning so you can have it as a reference for you. This calculator is found on the Freddie Mac website. And again, what it's going to do, it's going to allow us to take our current rent situation versus what it could look like as a home buyer. So I'm going to kind of put together this scenario, and for those of you that may have a cheaper level of rent or maybe not paying rent at all, it'll vary by your personal situation. But let's take a look at this scenario here. So let's assume we're paying rent of say $2,800 a month, right? Now for renting, we probably have renter's insurance. So we're going to factor in $15 a month for renter's insurance. And let's assume that our rent's going to increase 3% per year when we renew our lease. And then for the home purchase price, I know this will vary based upon where we're going to buy. We're going to just assume a purchase price of $650 for now, okay? And then the minimum down payment for a purchase price of $650 is 3%. And then property taxes on a $650 purchase, roughly about $7,250 per year. Taxes will range anywhere from 1.1% of your purchase price up to 1.25%. 1.25 is usually kind of the amount that most lenders will use for your qualifying. Now, if you're looking at new construction homes, there's a thing called Mello-Roos. There's special interest taxes. So that tax rate could be slightly higher if you're looking at purchasing a new home. Homeowners insurance, usually we, at that $650 purchase price, probably somewhere in the $1,000 to $1,500 per year. And then we're also going to budget maintenance. Now, when we buy a house, no longer can we contact our landlord and say, hey, I don't have any hot water. Can you help me out? I'm trying to fix this. You're going to have to obviously carve that out of your budget. So we're going to set aside $2,000 on an annual basis. Of course, if we maybe purchase an older home, we might want to set aside a little bit more in our budgets. And then for loan information, let's put in a 30-year fixed mortgage. That's what 99% of our first-time buyers are going to do. That's going to give us the lowest available payment. And then interest rate, we're going to plug in 4% for now. Now we're going to spend some time talking a little bit about interest rates in just a few minutes. But for right now in tonight's discussion, let's go ahead and input 4% there. Origination charges, that is what your lender will be charging you in costs for your financing. Those vary by lender. Now, one of the great things of being part of the Long Beach Alumni Network, we have our discount program that allows us to reduce our lending costs by $750. So normally we charge a $910 processing fee. That gets pulled down to $160 with our Long Beach discount. And then in buying a house, there's a thing called closing costs. And usually those are anywhere between 2% to 3% of your purchase price. And so if we take our lender charges, some of our third-party fees, some government recording charges, those should be probably in that 2 to 3% range. When you start elevating up to those higher purchase price levels, it's probably not going to be 3%, probably closer to 1.5 to 2%. But I would rather kind of plan for the worst. So I'd say maybe 2 to 3% worst case scenario. So that's part of our other settlement charges. And then the other assumptions we're going to make is the appreciation rate of our home. Let's say it's going to be 3%. I know when you see the market data, I'm going to show you in just a minute, it's much higher than 3%, but we want to be a little more conservative here because we want to make sure we're looking at a realistic depiction of what home ownership could look like for us down the road. We're going to say expected years in the home, 7 years. We can always change that figure. Selling costs of our home, 8% of the sales price. Now, it's important to know as a future buyer, when you have the representation of a realtor, the realtor commissions are paid for by a seller. It's not paid for you by the buyer. Now, when you turn around and eventually sell your home, let's say in 7 years, as we're using in this example, then you're going to be responsible for paying those realtor fees for both the buyer's agent that brings the buyer to your property, as well as the listing agent that represents you as a seller. So something to keep in mind down the road, 7 years from now, for example. And then state and federal tax rate, we're going to put 33.8 and then a savings rate of 1%. So what this calculator does is it says, okay, let me pull up the payments tab. So if I'm going to go ahead and continue to pay rent of $2,800 per month, and on the annual renewal of my lease, it goes up 3% each year. Now, if I compare that to a mortgage payment, now the mortgage payment is about $4,400 a year. So, we're looking at $1,600 more on a monthly basis. Clearly a big step up. But my opportunity, my total cost opportunity over 7 years in buying versus renting is about $99,000, almost $100,000 in opportunity over 7 years. Now, how does that money come, or how does that number come about? Well, if we look at, it's going to take into consideration equity. So my net sales proceeds at the end of 7 years. It's also going to take into consideration my tax savings at the end of 7 years. Now, when we look at that total cost, so we're looking at probably just almost $250,000, almost $250,000 in rent that we would be paying out over 7 years versus $149,000 in, net mortgage payments over 7 years when they compare the sales proceeds, like I said, and the tax savings. So clearly an opportunity for you in homeownership. Now, these numbers will look a little bit different for you depending on what your situation is with home buying. If you have a lower rent and you're looking to buy a $650,000 house, that's not going to be as advantageous for you. But this is just give you some help when it comes to budgeting, kind of planning for your upcoming home purchase. Okay, so that's our Freddie Mac calculator. Let's talk now a little bit about what's going on in the housing market. So this is a housing appreciation slide over the last 10 years. And what our kind of our look into this is kind of seeing what's happened, especially over the last couple of years. This gray line represents the start of the pandemic, and obviously our communities have changed forever given what's happened with our pandemic. And when we look at the housing market and what has changed is we have very limited inventory levels, and that's what's really driving a lot of this huge housing appreciation. So we have very limited inventory, high demand, and that's obviously driving upward pressure on prices. And we've kind of seen this really fast trajectory upward in house prices. And this slide looks at the greater LA, kind of Long Beach area. And we're looking at slides yesterday in Orange County, and that doesn't look much different than the trajectory you see here on this slide. And so we have that low inventory level, high demand. That demand's being pushed by or fueled by lower interest rates, different employment situation for consumers. So now more people looking to stay at home and work. So less commuting. So you're seeing a lot of pressure on, consumers looking to say, hey, you know what? I don't have to commute now. So I want to invest my energy in maybe purchasing a home. And most of that was that demand is really being driven by interest rates. Now, what we're seeing in interest rates, which we'll talk about in just a second, we're starting to see interest rates rise significantly, especially over the last 6 to 8 weeks. And so we'll see how that kind of influences the housing market. What our early indication is, it's really creating a big sense of urgency, especially with our own personal buyers that are out shopping right now, is to try to find something before interest rates start to climb that much more. Now, for us personally making a decision on buying, we want to make sure that we're still within our budget, even with the increase of interest rates. Now, what we're also seeing in the housing market is a little bit of softening in the market, where we're seeing homes that are starting to sit a little bit longer. So no longer are they kind of flying off the shelves right away. And so we're starting to see this, if you look at this trajectory, we're starting to see this maybe flatten a little bit in some markets. Last year, this time, we saw maybe 20 to 30 offers on one home. Now we're still seeing a competitive environment, but maybe it's 5 to 10 offers. The other thing to take into consideration when it comes to the value of your home, when we're lending as your lending partner, we only can finance based upon the appraised value or purchase price, whichever is less. So why that's really important is because in some markets, we're seeing the bidding pushing prices up beyond what the data supports in the marketplace. For example, if a purchase price gets pushed up to $650,000, but the market says the house is only worth $625,000, we have a $25,000 gap. And where that poses an issue for you as a buyer is that gap needs to either be covered for you as the buyer, or we have to renegotiate with the seller. And in some cases, we're seeing more frequency of gaps, meaning the market is starting to soften a little bit where it's not supporting those higher purchase prices. So I think the takeaway from this is that, there is some opportunities, I think, forthcoming for first-time buyers. We'll have to really kind of watch closely what's going on in the market, given the current state of affairs globally, and kind of see how that really impacts us at home in our local communities with our housing market. Now, as I mentioned earlier, interest rates have fueled a lot of the trajectory in our housing market. Rates have really seen a quick rise over the last 6 to 8 weeks. We grew accustomed to a sub 3% interest rate world, and we started growing accustomed to a low 3s environment. And kind of overnight, we rose into the high 3s and started touching into the 4s just in the last couple of weeks. And what's driving a lot of this is the inflationary concerns. Many of you who are joining tonight's call probably heard that the federal funds rate is going to be probably increased by 0.25%. And that's more than likely going to happen. And we'll see that here soon. That's already kind of baked into the interest rates that we're seeing out there. And when we think about the federal funds raising 0.25%, that's going to have a bigger influence on things like homes, equity lines of credit, auto financing, credit cards, things of that nature. The interest rates that we're seeing today for the mortgage market is already kind of being played out. And really what we're watching closely is what's going on with inflationary concerns. And then of course, what's going on abroad here with what's going on in Europe right now. So that's obviously a concern. And the stock market remains super volatile currently. We've seen the market increase, I think, almost 700 points today, where it was down just a day ago. And typically interest rates are going to work inversely to what's going on in the stock market. So the stock market has a good day, interest rates are going to probably perform as well. And we're going to see this volatility continue, especially what's going on across the world right now. So, it remains to be seen where interest rates go. Our average interest rate right now is we're seeing it fluctuate between 4 to 4.25%. And I think as we meet with our clients for consultations, we want to kind of plan for that higher rate environment. So we have kind of a worst case scenario when it comes to budgeting. Now with interest rates aren't all the same. Interest rates will vary based upon our loan programs. They can vary by our credit score. Generally, if we have a 740 credit score or higher, we're going to have the best available interest rates. And loan amounts can also play a role in the interest rate options for you, as well as down payment. And when you look at different interest rates, every lender will have options for you to pay what we call as points. So sometimes there's no point options and there's point options. And what a point is, it's generally 1% of your loan amount. So if I'm financing $500,000, 1 point would be 1% of $500,000 or $5,000. That's a cost that you as a consumer can pay to help achieve a lower interest rate. Generally, 1 point will equal a 0.25% reduction in interest rate. So if my interest rate with no points is 4% and I really want to get that rate down, I could pay 1 point and drop that rate from 4% down to 3.75%. If you have shorter terms on your interest rate or your loan, so maybe instead of a 30-year fixed, you look at a 15-year fixed, that will give you potentially lower rates. Most loan terms will come in 30 years, 25, 20, 15, and 10. The shorter your term, generally the lower your interest rate will be. Now, as first-time home buyers, we're probably going to be selecting a 30-year fixed mortgage because that's typically what we do, but there's certainly options to look at lower term programs. All right, let's talk a little bit about credit, because as we just mentioned, credit's going to influence our selection of interest rate. It's also going to impact what our available mortgage insurance is, and we're going to spend some time looking at that in just a minute. When we look at the FICO score calculation, there's a weighting here that's under this FICO score calculation. 15% of it's how long I've had credit. 20% is going to be how much credit I have in use or how much new credit I'm trying to get access to. So if I open up a new account or I'm getting new inquiries on my credit, those are going to be hard inquiries. And there's rules in lending for both mortgage and auto financing. So around hard inquiries, when I have a hard inquiry day one, I have a 30-day window of time to apply with as many lenders as I want. And it's the equivalent of one credit inquiry hit to my score. So that holds true for auto financing as well as for mortgage financing. 30% is how much I owe on my credit. So that's also known as credit utilization. And that pertains to revolving credit. So if we take our credit limits versus our credit balances, that difference is our credit utilization. As a rule of thumb, we want to try to have that utilization be below 10% of our credit limit. So let's say I have a $10,000 credit limit and I'm at $5,000 in my credit balances, then I'm at 50% utilization. So I want to do my best to try to whittle that credit balance down below 10%, or let's say $1,000. Now, quick tip when it comes to managing your credit card or line of credit, revolving debt. If you're one that tries to pay down your debt on your due date or pay it off on your due date, and you're really trying to maximize your credit score, I would really encourage you to take a look at your billing cycle date, because at the billing cycle date, that is the date at which your creditor is going to push the information, the balance information, out to the credit reporting agency. So for example, if I have a billing cycle that ends on the 20th and my due date's on the 4th, whatever my balance is on the 20th, that's the information that's going to be passed out to the credit agencies. So even though I pay off that balance on the 4th or pay it down on the 4th, if my balance is $5,000 on my credit card, that's what gets issued out to the credit agencies. So the tip is, if you can try to pay off that balance or pay that down before the 20th, say the 19th, then you're going to be able to kind of maximize your credit score for that particular billing cycle. So that's on the amount owed. The other 35% is pretty self-explanatory. It's how I paid my bills, basically my payment history. Payment history is weighted, or not weighted, but it's rated in 30-day lates, 60-day lates, and 90+ lates. So the more severe your late is, the more impact to your credit score. Every loan program has a different minimum credit score. So FHA loans, we have 600 on the slide, is actually as low as 580. Conventional loans are 620. VA loans are also 620, and then for the CalHFA assistance program, which we'll talk about later, it's 640 for an FHA loan and 680 for a conventional loan. One other thing I want to mention about credit score factors is around account closure. So if you're in the habit of maybe doing balance transfers, opening up an account, and kind of getting the better rewards benefits for a credit card, and maybe you close out the other credit card, you want to be careful with that, because if you close out the previous credit card and maybe that's your longest standing credit tray line, it could negatively impact your credit score, because the credit bureaus are, and especially around length of credit, are looking at how long you've had credit. So if you open up a new account and you close out the other one that's had your longest standing trade line, that's where you could see the dip in your credit score. Now, when lenders are evaluating your eligibility for different programs, they're going to look at 3 different credit scores. So they're going to look at the Equifax score, Experian, and TransUnion. We take the middle score of those 3 bureaus. So if I'm at 760, 740, and then 720 on my lowest score, we're going to use 740 as a score for qualifying. Now, if my partner is also going to join me in my application, we're going to take the lowest score between the 2 of us. So if my partner's at 720, 700, and 680, 700 is going to be the lowest middle score between the 2 of us. So that would be the qualifying score that we use for our lending. Okay, any questions on credit? We good? Okay, awesome. Like I said, if you have any questions as we're going through tonight's presentation, please feel free to go ahead and chime in, and we'll go ahead and bring those out to the rest of the group, the answers. This is a matrix so you can get a sense of if you've had past credit challenges on your credit report, how long those will be with you on your credit report. So hard inquiries are going to be on there 2 years or less. Late payments are usually 7 years. Now, if you've had a challenge, like a recent challenge, like a late payment, it's going to be the most impactful to your score in the most recent 1 to 2 years on your credit file. Once it gets beyond that 2 years, you'll start to see some organic improvement in your credit score. But in those first 1 to 2 years, that's where you're going to see the biggest drawback to your credit score. Let's talk a little bit about student loans. And with financing, especially for our first-time homebuyers, generally we're going to use 2 main products. It's either a conventional loan or an FHA loan. We're going to talk about programs in just a second, but it's usually those 2 core products. When it comes to student loan obligations, there's kind of 2 different lenses we put on those when it comes to looking at the monthly obligation. Now, if we're doing a conventional loan and you're on an income-based repayment amount, we're going to take that amount to use towards your qualifying. If you do not have an income-based repayment amount, we'll generally use 1% of the outstanding balance as your monthly payment. So if I'm on an income-based repayment amount of $250, that's what I'm going to use for qualifying. Now, for those of us that do have federal student loans, they're all in forbearance right now, I think until June. So what we'll do in qualifying, if you're looking to do a consultation today and figure out your options, we'll look at what your income-based repayment amount was prior to the CARES Act, which put the forbearance on student loans. Now, if you're back in school and you're just on deferment because you're in school, we still will have to count some type of minimum payment against you for qualifying. So for conventional loans, it's either the IBR payment or it's going to be 1% of your balance amount. With FHA loans, it's a little bit different. It's a default to 0.5% of your balance. But if you're on an IBR payment, so the same income-based repayment, we can use that. So if I take that same $75,000 in debt, the 0.5 would be $375. Or if I'm on an income-based repayment of $250, then that's an option as well. One thing with FHA loans, they don't allow us to have a 0 IBR payment. It has to be beyond 0. It's just one of the guideline requirements that FHAs have. So again, if you're back in school and you're in deferment or you're in forbearance, we do have to count some payment against you for your qualifying, because eventually, obviously, we're gonna have to start some type of repayment program with those student loans. So there's generally 5 core programs that we look at for home buyers. And as I mentioned earlier, for first-time buyers, it's usually conventional loans or FHA loans. But we also offer VA loans, which are for our veterans that have served, USDA loans. Those are going to be for more of our remote areas. And then jumbo loans, which will be for clients that are looking to purchase beyond the maximum loan amount of $970,800. And those are specific to like LA and Orange County. Now, with jumbo loans, just kind of highlight that really quick. When we look at financing for those requirements look a little bit different than maybe your conventional or your FHA loans. Jumbo loans have a reserve requirement, which means you need to have a certain amount of assets set aside beyond what we need for our down payment and our closing costs. So if we're saving up, let's say 10% for our down payment, plus our closing costs of 2 to 3%, we'll also need additional assets to cover reserves. So what reserves show a lender is that you have additional financial stability or support in case something was to happen, in case there was some issue with your finances. The reserve usually is 6 to 12 months of your monthly payment that you have in available assets once you've contributed to your down payment and your closing costs. So let's say, for example, I have a monthly payment of $6,000 and the reserve requirement is 12 months. That means I would need to have $72,000 set aside beyond my down payment and my closing costs. So that monthly payment takes into consideration your principal and interest, your property taxes on the house, and then if you have mortgage insurance. Generally on jumbo loans, you're not going to have mortgage insurance, but that will take all that into consideration. So like I mentioned earlier, there's usually 2 core products that we use for first-time home buyers, and that's usually the conventional loan and the FHA loans. Now with conventional loans, the conforming limit across the United States right now is $647,200. So if a buyer is looking to purchase or finance, I should say, up to $647,200, the minimum down payment is 3%. Once we go beyond a loan amount of $647,200, the minimum down payment now increases slightly to 5%. And that 5% down payment requirement goes from $647,200 all the way up to $970,800. So those are recent adjustments that just took place this year. Those loan amounts get adjusted every November or December. So we'll see another iteration of new loan amount adjustments later on in 2022. So that's what it looks like on a conventional loan. Now, as we learned earlier, a conventional loan minimum credit score is 620. FHA is a minimum of 580 to 600. With an FHA loan, the standard down payment is 3.5%, all the way up to $970,800. Now, the loan limits will vary by county. So if we go into San Bernardino or Riverside County, those loan limits will be at a $647,200 amount. So if we're looking to purchase in those markets, that'll look a little bit different. Now, when it comes to PMI on conventional loans versus FHA loans, it looks a little bit different. And PMI comes into play when you put less than 20% down on your home purchase. And so this slide kind of shows you what the differences look like with a conventional loan and an FHA loan. With conventional loans, PMI has various payment options. So you can pay back your PMI or private mortgage insurance monthly. You can do a split mortgage insurance where you can pay some monthly. You can also pay some upfront. You can just buy out your mortgage insurance with one single premium, or you can take a slightly higher interest rate. So let's say I go from 4% to 4.25, and that buys out my mortgage insurance. That's called lender paid mortgage insurance. The most typical way that buyers will facilitate their PMI is going to be through monthly MI. And the reason why is because that generally has a cancellation option. So once I have at least 2 years in my loan and 20 to 22% equity, I can apply to have the mortgage insurance removed. With conventional mortgage insurance, there's 3 key factors that play a role in the cost of your mortgage insurance. And what I've heard from a lot of our clients is that some of our calculators, like on Redfin or Zillow, that they're using really have a high level of mortgage insurance. And mortgage insurance is not as expensive as you might think, because it has 3 components to it that make up the cost of mortgage insurance. There's your credit score, there's your amount of your down payment, and your loan amount. So those factors make up the PMI factor that's used for lenders. So we have an example down at the bottom of the screen, which is if I finance $450,000, I have an average credit score of 740, and I put 3% down, the cost of the mortgage insurance is $183. So it's a little more reasonable than I think some of the calculators that you might find online will show. Now, with conventional mortgage insurance, as we know, if we put less down and we have a lower credit score, then we'll start to see that PMI lift a little bit. So I think with your tools that maybe you use online, they're using more of a general number, but through our consultation with you and kind of designing your home buying game plan, we can show you exactly what your PMI factor is going to look like. Now with FHA loans, it's a little bit different. FHA loans, regardless if you put 10% down, 3.5% down, 20%, you're still going to have mortgage insurance. So that's a big difference between conventional and FHA. The factor on the monthly MI for FHA is 0.85%. So it's 0.85% of whatever amount I finance. And then we divide that by 12. That's how we come up with our mortgage insurance. There's two components to mortgage insurance for FHA. There's monthly MI, but then there's upfront mortgage insurance. The upfront mortgage insurance of 1.75% gets financed into your loan. And a big factor with FHA is that the mortgage insurance cannot be canceled. So you do have to maintain the mortgage insurance for the life of the loan unless you decide to refinance into a different loan. So just something to kind of keep in mind as you're looking at your different product options. Now, the big thing is the cost of mortgage insurance looks a lot different. The monthly PMI is probably about 40% higher on an FHA loan versus conventional. And then of course we have the upfront PMI, which in this example here that I shared with you, it's just over $7,800 a year. $7,800 is a one-time fee. That $7,800 gets added into your amount finance. Now, all that being said, once you see the different options with FHA, especially around PMI, you may ask, why would I go that route with FHA? Well, there's a few different factors. FHA has a little more leniency from a credit score perspective. So it goes down to the 580 credit score. It'll also look a little differently at past challenges. So if I've had late payments, maybe a past foreclosure or short sale, they'll be able to kind of maneuver through that, where conventional loans, for example, on a bankruptcy, if I've had in the past, we'll want to see 4 years seasoning, where FHA, it's only 2 years. Or maybe I've had a short sale on a home and conventional will only require 4 years, where FHA is 2 years. So little nuances like that, and the guidelines may have to kind of make us navigate to one product over the other. These are the conforming limits for this year. As I mentioned, Riverside and San Bernardino is a little bit lower than the Orange and Los Angeles markets. Get up to Ventura, 851, and then down in San Diego, it's 879, 750. If you're joining us from our Bay Area markets, let's say you're in Santa Clara County, Santa Clara has exact same loan limits as Orange in LA. If you're in Sacramento, right now, I think it's at 698, if I'm not mistaken. But we can share those with you offline. Actually, we can put those in the chat box too. Okay, so that's a little bit about loan programs. Let's talk about some of the documentation required for home buying, and we'll kind of move through this relatively quick. So for our W-2 wage earners, generally we're going to need to get our last 2 years W-2s, last 30 days of pay stubs, and then we're going to do some type of verification of employment, usually a verbal and a written verification. If we're self-employed, we're going to require a little bit more documentation. We'll generally need the last 2 years of tax returns, profit and loss statement, some type of balance sheet. And then we're gonna have to verify the business online, whether through website, business license, maybe a CPA letter. So it might be a little bit more labor intensive for our self-employed individuals. Now, some of the questions we get from our clients in consultations is around the eligibility of different levels of employment or additional employment. So when you're, say, working 2 jobs, you do need to demonstrate that you've been on both jobs for 2 years. So let's say, for example, I'm in the healthcare industry and I work at one hospital 30 hours a week and another hospital 20 hours a week. As long as I can demonstrate that I've been on both jobs for 2 years simultaneously, then I can use both sources of income towards my qualifying. The other question we get often is, especially for our new alumni that's just recently graduated, is that if I'm graduating in the spring and I already have my job lined up in the summer, when can I start the pre-approval process? So if I have an executed offer letter from an employer, we can use that to determine your income. And the rule of thumb is that we need to have at least 2 years on the job or education supporting my career path. So if I've done 4 years undergrad at Long Beach State and now I'm getting my accounting degree and I'm going to work for Deloitte, for example, then that's going to qualify for me under a mortgage. So usually the rule of thumb is the last 2 years of either employment and or education supporting my career. Okay. Now, if you have a W-2 job and maybe you're doing Uber Eats on the side and that's just a supplemental income you have, in order to count the supplemental income, because it is truly self-employed income, we do have to show that you've been doing the W-2 employment as well as the additional employment for 2 years consistently. Okay. One other quick thing I'll just kind of add to this, obviously with what's changed in our communities with going through the pandemic and unemployment rates being what they were and many people losing their jobs and so now getting back into the workforce. The question comes up often is that, you know, if I had lower earnings in 2020 because of the pandemic or 2021, how is that going to impact me for my qualifying? And so it's a really good question, because when we look at qualifying, if you're on a base salary or guaranteed hours on an hourly wage, we can take the current income for you in qualifying. So even though your earnings may have been down in 2020 or 2021, as long as we can show guaranteed salary or hours for your current employment, we can use that for the qualifying. Where it can be a little bit problematic is if you're on a bonus or a commission structure and you had down commissions or bonuses in those 2 years and now it's improved, they're generally still going to do a 2-year average of your bonus and commissions. But again, if you're just re-entering the workforce and you can show stability of 40-hour work week on an hourly or a base salary, then we should be able to use the current income. With income, we're going to evaluate your monthly obligations versus your pre-tax income. It's a calculation called the debt to income ratio calculation. And it takes into consideration things like student loans, credit cards, personal loans, auto loans maybe, versus your pre-tax income. Sorry for the sirens in the background in case you can hear those. So we're in downtown Sacramento, and so there's always lots of activity here. So they've passed by now. But anyways, to get back to debt to income ratio, it takes into consideration your monthly obligations versus your pre-tax income. And so it's a calculation that all lenders will take consumers through. Usually we don't want that number to be beyond 43 to 45%, but it's not a true indication of affordability. Affordability is going to come by just understanding a little bit more about what your target budget is for you as a home buyer. So that's one of the things that we're going to talk through your consultation. We're going to look at, where am I at from a rental perspective? Where do I feel really comfortable at from a home ownership perspective? Because even though the debt to income ratio may say you qualify, doesn't necessarily mean it's affordable for you. Here's what the debt to income ratio calculation looks like. So it's taking in consideration your principal and interest, your taxes, your insurance on your house, the PMI on the house or the private mortgage insurance, along with the HOA or the Homeowners Association dues. So in this example, let's say I'm paying $2,500 a month for that, and then my total indebtedness is $500 per month. If we take those total obligations versus maybe a pre-tax income of $8,500 a month, then my debt to income ratio is 35.29%. When we get together for your one-on-one, if you so choose to do a consultation, we'll walk you through the debt to income ratio calculation. Most first-time buyers feel comfortable around a 33 to 36% debt to income ratio. But again, we're going to kind of talk through affordability just so we understand, what is the right number for us in our home purchase. Assets are another component of home buying, also known as down payment. So as lenders, we're going to verify the available assets for you. Generally, we're going to be looking at checking and savings accounts, if that's maybe where the money is that you're looking to use towards your home purchase. The last 2 months of statements is generally what we're going to ask for. If there's any large deposits or cash deposits, unfortunately, we can't use those. Now, deposits can be used as long as we can paper trail them. So let's say I got a really large tax refund. We can certainly obviously paper trail that. But if we've had cash deposits, maybe Venmo deposits that can't be kind of correlated, those wouldn't be used for our home purchase. Retirement accounts can potentially be used, 401ks, 403bs, IRAs. Was just talking to a client this afternoon about the 401ks, and 401ks can certainly be used. It probably is going to be our last resort. And the only reason I say that is because when you borrow against your 401k, you're taking money out of the market. So if the market is down, you access money and then the market appreciates and you've just taken a $10,000 loan out. Well, now you have $10,000 pulled out of your 401k that's not getting the appreciation in the market. So something we want to kind of take into consideration when looking at what assets we want to put towards our home purchase. Now, IRAs can potentially be used, but you really want to talk to your tax advisor, maybe your financial advisor, to see if there's going to be tax consequences with that. And then the final thing with assets that we want to speak to is just gift funds. And that's where family members can help contribute to your home purchase. There is no seasoning requirement on gift funds. So generally most assets need a season 60 days. That's why we ask for the 2 months of statements. But with gift funds, they can be transferred over instantaneously, and those can be used right away for the transaction. Now, when we're looking at home buying options and speaking to our clients throughout the year, there's generally two challenges that come across trying to get to the finish line when it comes to home ownership. It's usually either credit challenges or it's just lack of resources and savings to be able to meet the minimum down payment and closing cost requirements. So we work with CalHFA, which is the California Housing Finance Agency. And this agency is designed to help low to moderate income households across California achieve home ownership. And so we happen to be one of the leading providers of this product across the state. And so I always love to share this information in the home buyers workshops because it really kind of brings to light some of the opportunities for first-time home buyers that you may not have heard of. And so there's two components to the CalHFA loan. And it works, by the way, with a CalHFA FHA loan and a conventional loan. And if you elect the conventional option, it truly is a conventional loan, even though it's under the umbrella of CalHFA. And the way the program works is we have two options to add on support or assistance, which would be through the My Home Assistance or the ZIP Assistance program, or a combination of both. The My Home Assistance provides anywhere between 3%, so the minimum down payment for the 3% on a conventional loan, or 3.5% of the sales price on an FHA loan. Just a couple of weeks ago, the cap was removed on these assistance programs because before they were capped at $15,000. Now you can get the full 3% or 3.5% of your sales price. Super helpful in our high cost of living market, especially if you're in Long Beach and you're trying to buy a $700,000 house. You could get up to 3% or $21,000 in down payment assistance, which is super, super helpful for our buyers. So that's the down payment assistance portion of it. And then if we decide we want to add on the ZIP assistance, ZIP stands for Zero Interest Program. That allows you to borrow anywhere between 2 to 3% of your loan amount at zero interest. By the way, both of these programs do not require repayment until you either sell your home or if you refinance in the future. So really great tool to help reduce your total out-of-pocket expense. This is a great kind of slide to look at because it kind of brings to light what the out-of-pocket expense could look like on, say, a traditional purchase versus using CalHFA. I know this purchase price might be a little bit lower for some of us on tonight's call, but let's say I'm buying a house for $500,000. The minimum down payment, as we know, is 3%. So that's $15,000. Plus I need to carve out some savings for my closing costs, which in this scenario, maybe is $10,000 to $15,000. So I'm probably going to need about $25,000 to $30,000 to purchase my home. And for some of us, it's just, that's like a big hurdle right now. So maybe we can get to $5,000 to $6,000 or $10,000, but getting to $25,000 to $30,000 is just not going to be attainable. So with CalHFA assistance, where that comes in is that $15,000 down payment requirement can be supplemented by the My Home Assistance. So that $15,000 would help offset that 3% down repayment requirement. Plus, if we need the resource of the ZIP program, we can also get 2 to 3% of our loan amount for the closing costs, which in this scenario is like $9,700 to just over $14,000. And then those funds are used to help offset this number. So it'll probably be in a situation where we're not bringing no money out of pocket to buy, but we're probably gonna need to save maybe $4,000 to $6,000, which is so much more achievable than maybe $25,000 to $30,000 if we're just getting started financially. So that is on the conventional loan. There's also the FHA option, which basically does the same thing. But on an FHA loan, as you learned earlier, the minimum down payment is 3.5%. So that My Home Assistance can still come in, provide the support for the down payment assistance, or for the down payment, I should say, at $17,500. We can also add in the closing cost assistance of anywhere between 2 to 3% of our sales price. So just a great tool to help with our first-time home buyers. Now, there is some qualification requirements for it. You have to have a minimum credit score of 640 for the FHA component or product, 680 for the conventional loan. If you're looking to purchase a manufactured home, which was going to be for other probably areas of the state, minimum credit score is 660, but we could still finance those. Manufactured homes have to be on land that we own, can't be in a mobile home park. And then there is a debt to income ratio requirement. So the maximum debt to income ratio is 45%. Now the income limits are pretty lenient because in Orange County, you can make up to $211,000 in income, and it's only based upon the applicant income. And what that means is if I'm making $150,000 a year, my partner makes $100,000 a year, combined we make $250,000, but with just my income as say the applicant at a $150,000 annual income, I'm below the income limit, so therefore I could qualify just in my name. So that's one, kind of a cool little component of the first-time buyer program, because most programs will take a look at the entire household income. And also most first-time buyer programs aren't able to help buyers that make more than 80% of the median income, where this obviously has much higher income limits. Now, a first-time buyer is someone that hasn't owned in the last 3 years. So if I sold my house in 2010 and I've been renting ever since then, I'm still considered a first-time home buyer. Here's the income limits for the program. So LA has a little bit lower of an income limit at 158, but Orange County is up to 211. So these income limits will be adjusted every June. So we're just a couple months away from seeing these income limits adjust. My sense is we'll probably see LA come up quite a bit. The reason for LA being quite a bit lower than Orange County is because LA is just a much bigger county. There's just different varying income levels in LA County. Okay, let's switch over to a product I just like to spotlight before we get into some of our other final notes here tonight. And that is our medical professionals program. That allows to help our reserved medical doctors, dentists, medical teaching professors, newly licensed residents. Where this program can be a benefit to you if you fit the criteria is that for those of you that are coming out of medical school with maybe student loan debt, which more often we do, the student loan debt and how we qualify you doesn't look at the same way that conventional loans and FHA loans. So we have a little more flexibility. So this is going to help our clients that are trying to maybe qualify at higher purchase price levels, but need a little bit more flexibility with student loan and how that's qualified. The minimum credit score is anywhere between 700 to 720. Some of these loan amounts need to be updated based upon the program criteria and some of the new conforming limits. But like I said, it gives you a little more flexibility for some of our medical professionals. Okay, we're just now kind of transition into talking a little bit about the process of buying a house. We call this our 6 steps of home buying. There's milestones at each step in this process, from going from pre-approval all the way to step 6 when you're getting the keys to your home. And before we kind of start this journey on the 6 steps of home buying, a consultation happens. That's like a 30 to 45-minute session one-on-one with us over video or over phone, designing that home buying game plan. And then kind of the output of that meeting is going to be to have you pre-approved. Now, the pre-approval is a certificate that accompanies your offer to a seller. That pre-approval certificate can be adjusted to match whatever it is your offer price might be. The pre-approval is usually good for 60 days, but we can always recertify that document. You don't need to reapply or anything. So if I'm like maybe on sidelines for a few months, just kind of waiting to see what happens in the market, we can always update your pre-approval once you re-enter the market 60 days from now, and it doesn't require you to reapply. So that takes us to step 1, the pre-approval certificate. From there, the next milestone would be house hunting. And that's where you would generally partner with a realtor to show different options in the market. Now, all of us on this call probably have searched on Redfin or maybe on Zillow just to see what different options are out there in our communities and get a sense of purchase price. A realtor is going to kind of hone in your search a little bit. Generally, they'll have a portal set up for you based upon the characteristics of the home you're looking for. We have a fantastic network of preferred realtors that we work with. They kind of specialize in first-time buyers, whether you're buying in West LA or Irvine, wherever the case may be, we can get you connected with a professional. As I mentioned earlier, realtors are paid for by the sellers. So whether you find a realtor on your own or connect with one of our preferred realtors, we always recommend taking advantage of that resource, especially because the seller is paying for that resource. And then with your pre-approval letter, as you make offers on homes, we're gonna have a lot of different interactions with your realtors just to provide updates on your pre-approval. Generally, realtors will wanna have your pre-approval letter match your offer price. What that means is if you get pre-approved for $600,000, but you find a house for $550 and that's the right fit and you make an offer on that house, we'll change your pre-approval letter to match that offer. Okay, so let's say we're out house hunting, we find the house of our dreams, we make an offer and everything aligns and the offer gets accepted by the seller. Now we're gonna move to step 3 and that's called entering escrow. So that means a seller has accepted our offer and that starts the escrow time period. Usually it's about a 30-day process. So from acceptance to when you get your keys, it takes 30 days. Now, it still is very much a seller's market. So at times we're going to have to reduce down those timelines. It could be 21 days. So I'd say it's usually 21 to 30 days. Once that offer gets accepted, you as a buyer will need to submit your earnest money deposit, which is in 2 to 3 days. That deposit is usually 1 to 2% of your purchase price. Now that money gets held in escrow. It goes towards your total out-of-pocket expense, and we'll talk about this in just a bit, but it's held in escrow while you go through some of your due diligence on the property. Within 24 hours of the accepted offer, we're going to give you a call, schedule your follow-up video consultation. That's where we're going to get a chance to go through all the framework of your financing, talk about interest rates, out-of-pocket expense, set the stage for what to expect in the process, including your upcoming initial disclosures, which will be sent to you within 24 hours. We're also going to order an appraisal of the property. You heard me talk a little bit about appraisals earlier on today. So we're going to order the appraisal, and then your realtor will order any inspections that you plan to have on the property. So that's step 3. Now we're going to move to step 4, and that's called processing and underwriting. And that's where we're going to do some of the administrative work on your loan. Our team's going to verify your employment, your assets that you're going to be using for the home purchase. We may need a few other follow-up pieces of documentation. By that time, your interest rate has probably been locked in with your loan program. By the way, with rate locks, because we talked about the volatility of interest rates, first-time buyer programs like CalHFA, we can lock in that interest rate once you have an accepted offer on a property. And that's really how most transactions happen. However, with traditional loans on conventional or FHA loans, we have a thing called the secured lock program that allows you to lock an interest rate ahead of finding a property. That's something we're talking about more and more with our clients, because taking that kind of what if off the table and locking your interest rate is really important to clients. What's really cool about this program, it also allows you to have what we call as a free float down option. So let's say I lock in my rate at 4%, but the market starts to turn, and by the time I find my house, rates drop down to 3.75. As long as I'm within 30 days of my closing, I can drop down to that lower rate at no extra charge. So that's a really cool feature of that program. At step 4, the underwriter is also going to issue to you your final loan approval, and that's going to move us to step 5 in the process. At step 5, and I'm actually going to get back to it in just a second. Actually, before we get to step 5, I want to actually talk to you really quick. We got some of these slides out of order that I want to share with you. Let me just talk really quickly about earnest money deposit, and that's going to rewind us all the way to step 3. The earnest money deposit, as I mentioned earlier, is 1 to 2% of your purchase price. That money will go towards your total out-of-pocket expense, but the funds are protected in escrow because you have a timeline within your escrow time period called a contingency, and that allows you to do your due diligence on the property. So us as the lender will order your appraisals. So we want to make sure that appraised value matches your purchase price. Your realtor will order inspections on your house. And then of course, we'll get your loan approved. So those contingencies are usually in the first 14 to 17 days of your contract period. So if something, goes awry on those inspections and maybe you just don't feel comfortable moving forward on the property, you can cancel the escrow and get a full refund of your deposit. Now, the end of the contingency happens at step 5. So when we get to step 5, we're probably 3/4 of the way through the process. And once you're there, you have your appraisal back. You should know what your inspections look like, and then you have your loan approved with us. If everything looks good, then you can sign off on your contingency, and that tells the seller that you're moving forward in the process. Now, you just want to be really careful that you are comfortable moving forward, because once you sign off on the contingency, that tells the seller that you're all good. But if you cancel 2 days later or attempt to cancel 2 days later after sign off on your contingency, you could potentially risk losing your deposit. So you just want to be really careful with that. As a lender, we're also going to issue to you a final closing disclosure, and that's going to give you a 3-day cooling off period on your disclosures before we get the very final stage, which is called closing your loan. And that's where we sign final documents in person with the public notary. That process will take about 45 minutes to an hour. You'll be signing loan documents for your first mortgage. If you've elected any assistance program, we include that as well. Once that's been completed, you'll then wire in any other final funds that are owed into your transaction. And then on the lending side, we're going to do one more audit just to make sure all the I's are dotted, T's are crossed. And if everything looks good, we're going to wire in the funds for the mortgage as well as the assistance programs. That money gets collected by the escrow company. An escrow officer takes and ensures that you've contributed everything that you're supposed to in terms of the funds. That money gets balanced out with the seller proceeds and what you're supposed to contribute. If everything looks good, then the escrow officer will release documents to the county recorder's office. They record a grant deed that transfers ownership to you. They also record a deed of trust, which is your agreement to repay the loan. Once we get confirmation of those recording times, then the escrow company will confirm that everything's recorded, and then you'll reconnect with your realtor, hopefully to get the keys to your home, and then that's the end of the process. So then we get a chance to celebrate, get a chance to go get your hold your sold sign, celebrate, high five everybody because you made it through the process. So that's what the overall home buying process looks like. And again, we're going to send you all this material. So especially when you're out home shopping, I think it's really useful to have these tools to be able to refer back to. Yeah. Yes.
So if gift funds can only be given by family, what is considered?
Okay, so we're going to backtrack a little bit on assets, and that is a question around gift funds. So gift funds have to come from family members. So mother, father, uncle, aunt, siblings, that kind of stuff. So it does need to be something of that nature. You know, we've had questions come up, can an employer gift funds? And so we can't do that stuff. It does have to be a family member. And so that's something we can also talk about offline in different scenarios, but that generally is the rule of thumb. You've heard me talk a little bit about consultations this evening. So this is what the process looks like for a consultation. And in advance of that meeting, you would complete an online application, upload proof of income, assets. So really simple stuff, W-2s, pay stubs, bank statements. That stuff gets uploaded to your application. And then we would meet up over like video or phone. I prefer video because we can do some screen sharing, showing you different options, walk you through that process. And together over video, we would build a home buying game plan. And then like you heard earlier, the output of that is to have you pre-approved. Now, after you've left today's presentation, if you want to just kind of reconnect and go over some different scenarios, like we had the gift funds question that came up, or maybe you have just a scenario that you want to run through us with credit or whatever the case may be, we'd love to be able to connect with you for an introductory phone call. That's just a phone call for 10 to 15 minutes with us one-on-one. All the services that we provide, intro calls, consultations, they're all free services. We want to help provide you all the educational tools that you need to make this decision with home ownership. Here's the framework of the free personal consultation. So we're going to look at your housing situation, looking at affordability. We'll build the game plan. We'll talk a little bit about different areas you're looking at, looking for what the market looks like. We'll talk about interest rates, closing costs, the debt to income ratio, look at some different programs, as well as look at the process, what's going to look like once we lead that consultation to all the way getting to step 6. And then, like I mentioned, we're going to issue to you that pre-approval letter. We also have some fantastic tools that are available to you as clients, which we have our mobile app. You can download it for Android or Apple. You can start the application process right from your phone, upload your documents. You can also follow the progress of your loan. And the calculator on the mobile works really well too. So as you're going through step 2 and doing the home buying process, you can run different calculations for your payment scenario. Many of you are joining tonight's discussion because you heard about us through the Long Beach State alumni, which we're really excited to be in we're on the 1.5 years of our partnership with Long Beach State. Really great partnership and really proud to support our community there. We also have other partnerships across the West Coast with similar discounts. So if you're joining us from one of those other affiliations, we have the same discount available to you. So it's $750 off of our closing costs. So usually we have a processing fee of $910. That gets reduced down to $160. So all of our great partnerships, as well as just serving our communities, allow us to complete these free consultations and build that home buying game plan. And so, you know, we understand this is probably going to be one of the biggest investments you make in your lifetime. And so we want to be your trusted mortgage advisor through the process and really provide all the tools and resources you need to make a great financial decision for your future. Here's some of our upcoming classes that we have going on. So if you like all the content, you think maybe a friend, family, coworker would benefit from some of the stuff you heard this evening, they can always check out and register for our classes at mortgageeducate.com. We're going to be teaching another class to UC Riverside a week from today, as well as the following week we'll be doing an LA workshop. So love to be able to have other attendees check out this, or if you want to do a refresh, please feel free to sign up again. And again, that can be found at mortgageeducate.com. Here's all my personal contact information. So if you have a question, maybe after tonight's discussion, you want to just send me an email, give me a call or text. Here's all the ways you can reach me. You can also follow us on our social channels. If you wanted to schedule that intro call, or maybe you just want to get ready and get that consultation going, you can click on the schedule an appointment right here. And we love what our clients are saying about us, especially some of the reviews from our clients, our recent graduates from homebuyer classes, just like the one you're attending tonight. Check out some of those reviews on Google, Yelp. We're really proud of what we're doing with our clients. And we love to celebrate home ownership. So if you check out some of our social channels on Facebook or Instagram, we're always celebrating getting your keys to your house, because it's a special moment. It's again, a huge investment in your financial futures. And so we want to be that partner with you that celebrates the huge accomplishment. So with that said, we're going to hang tight for a little bit tonight. We're going to actually leave the lines open for a Q&A. So if you have any other questions that come in, I'm going to stay live, and then we'll get ourselves wrapped up. Again, I really appreciate everybody joining us this evening. We've been feel really fortunate to bring you this material. So I'm going to go ahead and just hang tight for a little bit. We'll probably go on. Oh, we have questions right now? Okay. Okay, and so we're going to jump into questions. Yeah.
So we have a question. Would any loans be able to be made for an entity such as an LLC from placing the property under such?
Okay, so a question came in. Is there any products that will allow you to finance into an LLC? So traditional loans like what we offer allow, you have to basically borrow in an individual name. So you can't buy in a business name. So it would have to be an individual purchasing or with a partner. There is certain companies that will do financing in LLCs. I think there's a company, I think it's Washington Federal, if I'm not mistaken, that does some of those financing options. But now some lenders will allow you to buy in your individual name and then transfer it to your LLC. That sometimes happens, but as a rule of thumb, if you're looking to purchase directly into LLC, there's special kind of niche lenders that do that. Okay. Okay. We're going to kind of hang tight for some Q&A. So if you guys have any questions, we're going to keep the lines open before we wrap up tonight. And I'll kind of shut down video here for a second, but I'll be right back on.